Let's take a step back from the day to day, from the predictions of bull markets and bear markets. Let's zoom a little bit out and think about what's actually happening over the decades. I think there is an interesting but also very concerning trend. It seems like from one investor generation to the next, people are getting more and more risk on. People are taking more and more risk. And that's not just on the private level, that's also on the public level, on the governmental level, right? There's a higher debt to GDP ratio. So in other words, even the US economy is getting more and more levered. Now, think about the typical financial advice people got, say, 40, 50 years ago. The typical approach most people took was just buy a 60-40 portfolio split. So you've got 60% stocks, ideally broadly diversified, and you've got 40% bonds. And potentially you also have a house, and very often that house was maybe paid in full, or at least with very little leverage, with a short mortgage, maybe 5 or 10 years. Now think about how this has developed over the years, right? Mortgage durations got longer and longer. We are now at a typical 30-year mortgage. A 50-year mortgage is going to get increased, basically increasing the leverage in the mortgage market. When we look at the typical investment portfolios, nobody, at least on a private level, buys bonds anymore. Everybody buys stocks, and preferably those stocks are also not just broadly diversified across all industries. More and more people might still buy the S&P 500, but at the same time buy more risky stocks on top of that. So that's normally also technology stocks, right? Tesla or Nvidia or Google or Amazon. So it seems like over time, things get higher and higher levered. We've also got the introduction of crypto, right? Crypto being the most volatile of the assets. And then even on top of that, leverage in crypto with perpetual futures. We've got the meme coins that also have inherent additional volatility, inherent additional leverage in it. So it seems like the market is getting more and more risk on. Now, why is that? What has changed over the years? Or let's say rather over the decades? I think one major thing that has changed is capital concentration. So in the early days, right, let's say 50 years ago, it was okay for an entire household to just have one major income, right? One earner, typically the husband, typically the man of the family, that was able to provide for the entire family, buy the house and save enough for retirement for the entire family, also have enough capital available to send the kids to university. Nowadays it's very different, right? We've got two incomes per household usually. We still have to take on debt to pay for tuition for college. And mortgage rates got longer, etc. So what seems to be happening is that the purchasing power seems to be diminishing over time, the purchasing power per hour worked. And so this might be due to technological progress, it might be due to capital concentration, it might be due towards fewer and fewer companies making more and more of the profit. But there is this long-term trend, which then in turn means that the vast majority of the population, the vast majority of investors, they tend to struggle to just keep up, right? They might get an inflation adjustment, just a purchasing power adjustment if you look at consumer goods, because maybe consumer goods don't go up as quickly as, say, for example, house prices. So they might get the 3-4% increase per year. But on average, the monetary base, it expands by 6.8% per year. So that delta in expansion, right, the devaluation of the currency relative to how much people earn and how much they increase their income, that devaluation compounds over the years. And if you just look at that delta, you compound this over 30 years, you're looking at a decrease in purchasing power of roughly 50%. So every generation, every 30 years, the next generation tends to be able to buy just half, say, of land, half of property, half of gold, with the same kind of working effort. And so that's a fundamental problem. So because the average person is having a harder and harder time of keeping up, they are forced basically to take on more risk. If you've already made it, if you've already got millions and millions of dollars, you can play it safe. The only important thing is that you don't lose your capital. But if you're still in the growth phase, if you still need to accumulate enough capital to save for retirement, to get your family through, if you're in that situation, you have to take on more risk. You're basically forced to, because taking on no risk, no investment risk, is basically a safe bet that you're going to fall behind further and further. And that's probably the reason why all investments get more and more inherent leverage built into them, why everybody is leveling up more and more, and why everybody has this inclination of gambling with the capital. Because now we are required to do so, right? It wasn't needed just 30, 60 years ago, but now increasingly from generation to generation, it's more and more necessary. And that's probably what draws all of that attention, what draws all of that attraction towards, say, crypto and towards the meme coins. It's just another hope to get out of this rat race. It's another hope to kind of be able to catch up again. Stack on top of that, the information age, the social media age, the easier way to compare ourselves to others, right? Our horizon of who we compare ourselves to has expanded massively. In the past, we just had our neighborhood. Now we've got Instagram. Now we think we're not really catching up unless we've got the Lamborghini, unless we've got the Rolls Royce. We have to work hard enough in order just to be what we then consider slightly above average. But there are only so many extremely luxury cars out there. There are only so many mansions out there. So really, this screws perception as well. And so all of this increases risk-taking. All of this increases the appetite for risk. The long-term danger with this is that if there is leverage and we lever up more and more and we take on more and more risk, it's just a matter of time until the risk materializes, until we do see the drawdown, until we do see money getting lost. The more risk we take, of course, the higher the likelihood for a loss is. So if you, for example, speculated with meme coins just 1 or 2 years ago, if you've been part of the Pump.Fun ecosystem on Solana, there's a very good chance that you've actually lost money with that. And so then you might take it a step back. You might go, okay, then I just go into Bitcoin, Ethereum, and Solana. But even that at some point might end the outperformance, right? Bitcoin did get a lot of adoption in the early years, but if you look at Bitcoin's performance relative to technology stocks in the last 5 to 6 years, we don't really see that much more outperformance. So just look at the performance, say when Bitcoin was at 20K, right, in 2018, and its growth to today, right, 100K, a bit less than that, and compare that with how much the Nasdaq 100, so the top technology stocks, grew during that period. It's the same ratio. It's a 4 to 5x. So both assets performed the same, but Bitcoin is much more risky than technology stocks, at least in terms of price volatility, right? Bitcoin can drop by 80, by 70%, so there were 2 major drawdowns during that time period. It can drop massively, much more than technology stocks did during that time frame, yet it performed the same. So this additional risk that was taken on by buying Bitcoin over technology stocks was not compensated for. The same way as meme coin investments, this additional risk that we got with that did not get compensated for with additional return for the average investor. And so that's a potential danger, right? This might cascade further, as in maybe technology stocks won't be able to outperform traditional stocks anymore. At some point, there might be overinvestment in, for example, artificial intelligence. And so if all of these investments in those data centers don't pan out to be profitable at the end consumer level, right? If the end consumer doesn't pay enough for those artificial intelligence features, or if the value creation of AI isn't high enough to justify all the spending, then the data centers, the hardware has to be written off. And then a lot of the technology stocks will likely underperform all other kinds of stocks. And so we could just spin this further and further, right? Maybe at some point the 60-40 portfolio becomes attractive again. Maybe the 60-40 portfolio, so having 40% of capital in bonds, might outperform even the S&P 500. So you know where I'm going with this, right? It seems to be cyclical. It seems to be happening that because people fall behind, there's more and more risk-taking. That risk-taking did get rewarded to a degree. Then at some point, the risk isn't really worth it anymore. The outperformance isn't there anymore. And the people that were able to escape the rat race by taking a lot of risk, they then suddenly, if you're not prepared, lose a lot of those gains and they fall back. And it's only a very small minority that is able to keep the wealth. And so we might just live through exactly that scenario right now. The S&P 500 even, right, when we look at the historical PE ratio, the Shiller PE ratio, so feel free to just Google that, Shiller PE, price to earnings ratio for the S&P 500, that's currently at historical heights. It's at 39 roughly. So if you buy a company now, an average company in the S&P 500, that company has to work for 39 years in order to justify its valuation. So it's 39 years of earnings that equals the valuation of that company. So if we just turn this into percentage returns, right, that's only 2.5% per annum, right? 1 divided by 40 is 2.5%. So when we look at that valuation and we put this just in relation to risk-free assets, right, where we get 4 to 5%, is it really worth it to take on all of that volatility? It's a big question mark, right? It's only worth it if we really expect that money is going to continue to devalue very, very quickly. But if all of those AI investments, for example, they're not profitable, people are going to look for something risk off again. And then they might move into gold, they might move into treasuries, they might move into all kinds of things, maybe even safe property, so not very levered property, not the property in urban areas, but say the farm or the farmland. Those might then be kinds of investments that actually appreciate. And I think a lot of people have forgotten this because we have been in this expansionary period since 2009, right? We had the dot-com crash in the year 2000, then 2001, 2002, so massive deleveraging of the technology stocks. Subsequently, we had the global financial crisis. That was in 2008. It finished in 2009. So at the beginning of 2009 was then also when Bitcoin was created. And since Bitcoin's creation, we haven't really seen any major recession anymore. The only thing we saw was COVID. But during the COVID crash, stocks on average only fell by 30%. And Bitcoin during that time fell, by the way, by 60%. So Bitcoin was just a levered bet on the overall economy. So there is a lot of correlation between the two. But that was everything that we've seen since 2009. We've seen way bigger collapses of the stock market prior to Bitcoin's existence. And so that then, of course, raises the question, right? If Bitcoin already has not outperformed technology stocks in the last 5-6 years, right? If it already didn't do much better despite the much higher volatility, if it was already risk-adjusted the worst investment, then how is it going to perform if all risk-on assets are going to come down? Very often we have these spillover effects, right? It's simply just general leverage in the system. So when .com went down, right, when technology stocks sold off, the S&P 500 also went down quite a bit. Not by as much, but still it went down. Or when the global financial crisis happened and the property market in the US had this massive collapse, that also went through to the S&P 500. It also went through to technology stocks. So there is some correlation. There's some intertwining between those asset classes. If one asset class sees massive losses, this tends to spill over to other asset classes as well. At least if those asset classes are also tied to liquidity movements. So you might see something like gold that can outperform during a crisis. You might see bonds outperform during a crisis. But very often things that have at least some kind of inherent leverage in them, and that's stocks, and that's property, those kinds of investments tend to go down together with the economy. There seems to be quite a bit of correlation between them. And so yeah, the message of this video is just make sure that you're not overexposed with your investments and also with your income potentially in case we hit a crisis. Because most people don't really realize how much all of their financial situation is tied towards the business cycles. Because let's say we go towards a downturn, right? Let's say the AI bubble was really to pop and AI stocks, technology stocks, they crash. Then at the same time, we will also see how other stocks go down. Now, if other stocks go down, then in general, most companies will have a harder time raising money. Most companies will become more conservative in their financial approaches in general. Most companies will stop hiring and profits might also fall. So just because data centers aren't profitable, that can spill over towards even, say, Coca-Cola not making money. And because data centers aren't used that much anymore, that can also lead towards energy companies losing traction because they sell a lot of their energy towards data centers, and they might have even built plants just to support the data centers. So there is a knock-on effect, right? If then suddenly general companies, like even conservative companies like energy companies, they start laying off people, then this will also potentially impact the property market because then maybe mortgages default. So that's a problem, right? Unemployment tends to rise during an economic downturn, and very often all of those things are correlated. So it might not only be that the investments go down in value, it might also be that the regular cash flow is suffering. People get unemployed, or people at least don't get raises as much, or people don't get the bonus, the year-end bonus anymore. So everything suddenly becomes tight. In other words, when it rains, then it pours. And most people don't really see how much connection there is. And very often, the people that tend to make most money now, they tend to suffer the most now. So let's say you're currently employed at a tech firm, let's say at Google, and you're based in the California area. You've got a mortgage there. Then if Google suddenly stops hiring, if Google suddenly stops increasing salaries, then suddenly you might also have a problem with paying your mortgage, and suddenly house prices go down. So even if you wanted to sell your house, you can't really sell it for any kind of profit. So it is worthwhile to think about how can we potentially invest in something that hedges us, not just hedges the wealth, not just hedges the portfolio, but that also hedges our cash flow. Because only very few people actually have counter-cyclical cash flows. So if you work for a company that makes money when other companies struggle, then you've got something counter-cyclical. But most people don't have that. Most people tend to also lose their cash flow or get less cash flow during an economic downturn. So if you're one of those people, and I am myself in this camp, right? If suddenly crypto was to never recover, if Bitcoin was to crash with the NASDAQ 100, if the NASDAQ 100 suddenly goes down by 60, 70%, and Bitcoin was to go down by 90 or 95%, then nobody would be interested in crypto anymore. Then the views of this crypto channel would go down, and my income would go down as well. And so I also have to hedge myself against that. So I'm not just hedging my portfolio by buying, say, gold, or by buying treasuries, or by shorting certain overvalued assets. I'm not just hedging my net worth with that. I'm trying to even overhedge a little bit, make money during a downturn, so that then also compensates for a lack of cash flow, or for at least less cash flow. So think about it this way, right? You are much more exposed to the cycles as you might think. Everything is interconnected, and it is important to come ahead out of a bear market. If you are the only one that still has capital when everybody has lost capital, when everybody has lost the cash flow, and you're the one that has been hedged enough, then you are the person that's able to buy the stocks for the cheap. You're able to buy the house and mortgage that up for very cheap. You are able to take advantage of all of that. And that's much more valuable, in my opinion, than trying to squeeze out the last few percentage returns at the end of a potential bull market. We have expanded for such a long time in risk-on assets. Price to earnings ratios are so high. There's really just a matter of time when we see the next downturn. And we don't really know what the trigger will be, right? Everybody thinks that it's going to be the AI bubble that's going to burst, but it could also be other things, right? It could be a debt crisis in the US. It could be commercial real estate being in trouble because everybody works now at home. It could be all kinds of things. It could be another banking crisis. We cannot really predict the black swan. We can only predict that black swans do occur at some kind of frequency. And we haven't seen a black swan since 2009 outside of COVID, and COVID wasn't really a real bad enough of an event. Of course, for private living, it was quite problematic, but for investments, it wasn't that much of a deal. And this could be different next time around. And so the only message here is please diversify. Please buy some assets that are counter cyclical. So don't just buy many stocks. Don't just buy many cryptos. Buy things that will actually appreciate when everything goes down, so that you will come ahead when everybody else is suffering, and that you can then take advantage really of the next bull market. Right? Most people think, had I just bought stocks in 2009 at the height of the global financial crisis, I'd now be rich. But the problem is that in 2009, most people didn't have that additional capital, that exposure, that's additional capital to just buy the dip. Most people lost jobs or lost their bonuses and just didn't have the capital. And so you need to put yourself in a position to be ready when the situation is right. So there's a reason why people like Warren Buffett have the highest percentage cash allocation ever in history, right? He's now so highly allocated towards risk off because he's anticipating that at some point something might blow up and valuations are simply not that attractive. If you're getting effectively 2.5% on your capital by buying stocks now in the S&P 500, while the risk-free rate is higher than that, then why really play that game? I think it's better to be rather cautious and be hedged against all kinds of scenarios. If you enjoyed this video, feel free to give this a like. Feel free to also subscribe. I publish these regularly. And see you next time. Cheers.